So first of all, private equity is a long-term asset class. And as a result, investors should look at it with a long-term lens and outlook. And based on Cambridge Associates data, if you look over a 10, 15, 20-year time frame, private equity has consistently outperformed other liquid asset classes. And as a result, we believe it should be a key part of any investment allocation strategy. In terms of performance during distressed periods, if you go back and look at funds that were raised post the dot-com bubble and the GFC, those have been the strongest vintages, producing outsized returns. So again, looking at data, the median IRR for 2001 vintage funds in the US was about 15.5% versus about 12% for 1999 vintage funds and about 13% for 2000 vintage funds. And similarly, for 2009 vintage funds, the median IRR was about 21% versus a little over 12% for 2007 vintage funds and just under 12% for 2006 vintage. So similarly, top quartile returns for these vintages are also substantially higher. And the key reason really for this is that investments made during times of market dislocations have benefited from more attractive valuations, right? Better EBITDA multiples and better capital structure. So the average multiple from 2001 to 2004, the time after the dot-com bubble in the US, was about 7.2 times enterprise value to EBITDA versus about 9.3 times in the pre-2000 recession. And similarly, the multiple was about 8.2 times between 2009 and 2013, the post-global financial crisis period, versus over 10 times right before. But also, I would say, based on the data from prior crises, what we've seen is that even private equity investments made prior to the downturn, while they may experience short to medium-term volatility, companies that are fundamentally strong and cash flow generating will recover in due time as the economy starts to come back. What is different about this crisis is that first and foremost, it's linked to a healthcare crisis. And two, the pace of decline this time was much faster than anything we've ever seen. So for context, in the first week of March, we had about 3.5% unemployment, and we had 5 million unemployed. We went from that to the end of April, where we had about 15% unemployment and 33.5 million unemployed. And before the surprising job numbers that came out last week, which showed about a 13% unemployment, everyone was expecting the US to hit about 25% unemployment this summer. So we went from having one of the strongest economies in the history of this country to mid-teens unemployment in a very short time frame. And in terms of the public markets, it took us just 22 days this time to get into bear market territory versus 42 days during the Great Depression and about 247 days during the GFC. And the third big difference this time is that we had an unplanned shutdown. Now, typically recessions are caused by some dislocation in some sector, whether that's the financial markets, whether that's energy, whether that's real estate or some other sector. This one was really led by the public health crisis, which led to an intentional shutdown of the economy. And it's hard to forecast what type of impact that would have on the consumers or the citizens as when things open up and they go back into the economy, and how that might change consumer behavior. Now, in terms of private equity, we believe private equity funds with dry powder are very well positioned in this market to take advantage of the opportunities that are being created. And also, as I mentioned, private equity is really a long-term asset class with view towards long-term value creation rather than being influenced by quarterly earnings or short-term stock price movements. And at Flexstone, we are very well positioned as well to take advantage of these opportunities in this market. And we will continue to remain very disciplined and maintain our disciplined investment approach that to date has generated about a 2 times ROI across our 90 co-investments to date and a 3 times ROI across our 38 realized investments. So at the sector level, I would say that some sectors are more impacted than others. At a broad level, clearly sectors such as retail, dine-in restaurants, leisure, travel, and entertainment, and energy were more directly hit. But you can't paint these sectors with a broad brush because even within these sectors, there are pockets of opportunities. So you really have to be very selective in terms of which subsectors you're focusing on. So Flexstone focuses on the small and middle market segment, which we believe has the most attractive opportunities and potential for returns due to opportunities to add value to the underlying companies and pursue add-on acquisitions. At the same time, the middle market companies tend to have less leverage on them as well. And this segment, this of lower and middle market, is typically more resilient in terms of macroeconomic market volatility. And in fact, during this pandemic, when we look at our own portfolio and March valuations in particular, the small and middle market funds have generally been a lot less impacted. In terms of sector specifically, though, we are seeing opportunities in healthcare, particularly around pharma services, around telemedicine, and cost management. We're also seeing opportunities domestic industrial manufacturing sectors as we think that after this pandemic and given that we had a tariff war right before that, supply chains are likely to get shorter. We're also seeing a lot of opportunities in food and beverage, not in terms of, again, supplying to food service sector, which has been impacted, but personal consumption. And a lot of food and beverage consumption has gone up with many of the stay-at-home measures during this pandemic. Lastly, I would say we're seeing a lot of opportunities in the technology sector, particularly around software and B2B. And that's really driven by the fact that that sector has been a lot less impacted with recurring revenue stream and SaaS business models and increasing role of technology across all industries, particularly in this new virtual environment. At the same time, I would say we're also looking at many add-on acquisition opportunities, and we think it's a great time to pick up some of the smaller companies at very accretive valuations. GPs have been working very closely with their portfolio companies. And I would say, there are many of the GPs that have been around for a long time and have seen the GFC are taking many of the lessons that they've learned from prior crises and being very proactive and quick in their response. So first and foremost, they've been focused on liquidity and preserving liquidity at each company to make sure that these companies can survive and get to the other side. They've been developing strategies to minimize impact on the top line, as well as prevent customer loss. They've been focused on cutting expenses and deferring all non-essential, I would say, expenses and CapEx. They've been focused on improving operations, as well as looking at efficiencies in their portfolio and actively working with their lenders on any covenant resets or really kind of being in active dialogue, I would say, prior to any issues that could come up in the portfolio over the next few quarters. Exits will likely be delayed in this environment about, I would say, at least 8 to 12 months. And this is really not surprising because if you look at the buyer universe, right, they would like to get more clear visibility on numbers. So they would like to probably see at least 2 quarters of financial performance in this new normal to get a better sense of the numbers and valuations. And on the seller's perspective, I don't think any sellers would like to sell basically off of these depressed numbers over Q1 or Q2. So there will likely be delays in exits, and there will be a more greater period of price discovery as both buyers and sellers kind of readjust expectations during this period.